And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story, real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning and welcome to the Hump Day edition of The Real Investment Show. Of course, today is the most important day of earnings season. Nvidia reports tonight after the bell. Of course, all eyes on Nvidia because it will make or break the market. Nvidia makes up about 6.5% of the S&P 500. So, I mean, it is a significant weight in the index. So goes earnings, so goes the market, really, and that's the big problem here. As Goldman Sachs noted this morning, Nvidia is the most important stock in the world. So just kind of goes to show you how important this is. But again, markets have had a very nice rally from the lows. We'll talk about this in a few minutes, but that could all change tomorrow. Or it could be a really good day. You'll all know at 8:30 in the morning when the market opens. But that's going to be the really big market moving event today. PCE comes out later this week as well, so we'll have another look at inflation from the Fed standpoint. But outside of that, it's really been pretty quiet this week so far because as you know, obviously everybody's just been waiting for tonight's earnings, and that's going to be the big driver after the bell day. Of course, we'll kind of review those earnings tomorrow. It's really not going to be about earnings itself. That's really not going to be the issue, right? They're probably going to beat earnings, or at least meet them, and that's the problem. Expectations are very high for Nvidia. So if they could come in and beat earnings, but just maybe not by enough, or maybe the profit margins weren't as high as everybody was expecting, or maybe their outlook is a bit softer. One of the other big concerns is they had a setback in the development of their new Blackwell chip. Well, maybe and of course Nvidia addressed that, and one of the reasons stock took a hit a few weeks ago was because of that delay in the production of the Blackwell chip. But if they come out and Nvidia addressed that and said, oh yeah, we've got all the production problems behind us, they'll be out by the end of the year or so. But if something comes out and they say, well, we're going to have further delays in the delivery of that chip, that's going to impact. So there's a lot of downside risk versus the upside potential. This is one of the reasons that yesterday we own Nvidia and both our equity model and our dividend equity growth model. We reduced both of those positions slightly yesterday in the portfolio because they've already had a big run this year. Just as an example, in the dividend equity model, which we launched on January the 19th of this year, that one position was already up 94% from just that date. So we just took a little bit of profit, reduced that risk because, if you're taking a look at the betting, kind of the probabilities versus probabilities of tonight's announcement, there's far more risk of a disappointment than there is the potential for overachieving results. Now, again, they may do that. I'm not saying that, Nvidia is not going to come in tonight and just kill it, and they probably will. But if you just look at kind of on a risk management basis, there's a lot of things that could kind of spook the markets in terms of Nvidia because it is such a large weight in the index. Again, just softer guidance, just meeting already lofty estimates. Wall Street is very optimistic on earnings. So there are many, many reasons why tonight's announcement could disappoint the market, and that puts some downside risk, in the markets. Now, having said that, if they come out tonight and they kill it and the stock is up 10% tomorrow, great, we still participate. And at some point, we'll get a pullback and we can add to the position. If the stock opens down 10% tomorrow following earnings, then we can reevaluate our position and add to it on the dip. So, longer term, we still like the company. There's nothing changed fundamentally about its positioning in AI, or they are the leader in the semiconductor chips. I just bought a brand new computer for my office at home because we're going to develop some new tech, and it's got Nvidia GPUs in it. So I mean, it's this is all they have a very large moat to their industry. So fundamentally, like the company, it's just extremely expensive. And really, no matter how you look at it, it's extremely expensive on multiple levels. But they are the leader in the industry right now, and they're the leader in the AI development, and they're a very major weight in the index. So as goes Nvidia, so goes the index. So if we want to provide performance for clients, we have to own the companies that are performing. So we'll see what happens tonight. Tomorrow's going to be a very interesting day. But speaking about the markets and what can happen tomorrow, let's talk about what you need to know before the bell this morning. Markets have been kind of hanging in here for the last couple of days. So we had this we had this correction. So let's do a quick review. Back in June and July, we were talking about this market was rallying higher. We were starting to develop a pretty big deviation between the market and the 200-day moving average. And we were talking about the need for a 5 to 10% correction sometime, before the election. And we got that. We got basically about an 8.5% correction from peak to trough. A lot of that happened very quickly over the course of about 3 days. And that was that whole Japanese yen carry trade blow up event that occurred. And then the market very quickly and rapidly, as corporate buybacks opened back up, that window very quickly recovered. It's a very, very sharp recovery in the markets. And again, and there's some ways this is has been a very bullish recovery. Breadth has expanded. We've seen a much better participation in the number of stocks that are actually moving higher. The advanced decline line has turned back up and is now approaching new highs. All that's very supportive of the market advance and suggests that this market wants to try to continue higher. Now, for now, this correction is over. For the moment. Now, again, that could all change after the bell tonight. We'll see. But for now, this correction is over, and the odds are at this moment that we're going to break out to new highs, and that could be tomorrow if Nvidia reports really good earnings tonight. But right now, like I said, everybody's kind of just waiting here, bated breath to see what's going to happen by tomorrow. One thing that is also interesting is that we've talked about the volatility index. We had this very sharp spike in the VIX. That is completely reversed. So again, that brief moment of fear is over. And so volatility has returned back to very, very suppressed levels. Again, as is always the case, when you have dropping volatility, again, that's people that are becoming the market in general is becoming much more bullish on the stock market. And again, we're back to levels that we had preceding this entire kind of run from October of 2022. We've had very, very low volatility here, and that's helping support the market. One of the interesting things that are going on, though, worth paying attention to, is the dollar, which has been under a lot of pressure as of late. And again, we've seen this, the dollar was holding in a pretty decent topping pattern. We triggered a sell signal back in early July. That's corresponded with a sell-off in the dollar. The dollar now getting really, really oversold here. So we could start to see a trade within the dollar of the dollar getting stronger here because, again, we've worked off a big chunk of that overbought condition that we had. We've had a decent correction in the dollar in anticipation of kind of the Fed rate cuts that are coming. So again, we could start to see a stronger trade in the dollar, particularly if we begin to see economic growth kind of get a little bit of traction. And we're seeing some of that confidence picked up yesterday in the consumer confidence report, better outlooks about the economy over the course of the next 6 to 9 months. So again, if we start to see some improvement in the manufacturing side of the ledger and services continue to remain strong as they have been, that should lead to a stronger dollar activity, into the end of the year. We'll keep watching that, though, because this is going to have a lot to do with that Japanese yen carry trade because these two currencies are trading off of each other right now, and that's one of the risks that's still sitting out there. Okay, that's what you need to know before the bell this morning. We'll come back, pick up Danny Ratliff, and talk about why stop it. Stop worrying about taxes. Let's go make some money. We'll talk about that next.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Building anything of substance requires careful planning, including your retirement. You need a blueprint to structure your funds against volatility and turbulence in the market. If you fail to plan, you plan to fail. Richard Rosso and Danny Ratliff share the RIA Retirement Blueprint. Saturday, September 14th at the Hyatt Centric in the Woodlands. How to structure your savings, level your risk, and craft a secure future. Register now for the Retirement Blueprint with Ratliff and Rosso at realinvestmentadvice.com. Realinvestmentadvice.com.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. Realinvestmentadvice.com.
The Real Investment Show.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll free at 855-RIA-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So a few things this morning to kind of get into. One of those is, let's talk a little bit about taxes. I had an interesting email yesterday, and ironically, I got an email from Danny this morning. Danny sends over topics for the show, and he had almost identically the same question. Let's talk about why you should stop worrying about paying taxes. Right? This is one of the most frustrating things that I deal with clients on a regular basis is they're so worried about paying taxes. You know, you've got a big gain in something, and look, nobody likes to pay taxes. Hey, I get it, right? But it's better than losing money, right? Or losing an opportunity. And particularly when you're talking about paying a 20% capital gains tax versus 35% income tax or whatever your income tax bracket happens to be. My income tax bracket is 0, so I don't really worry about it. I'm just teasing. It's really, it's not. But, you know, we've got to keep in perspective, you know, what we're trying to do, which is our job is to make money. Unfortunately, we have allowed 200 years plus of policy to be put into place to bring tax. Remember, the whole reason we founded the country was not to have taxation without representation. And the original income tax was a 3% tax on the wealthy. Taxes always start out with a function, and this is why you got to be super careful about politicians. Yeah, you know, Kamala Harris says, we're going to go tax the wealthy. It sounds great, right? We're going to go get those guys. All those wealthy people, we're going to make them pay more taxes. Okay, first of all, the top 10% of income earners pay about 90% of all the taxes. The bottom 50% pay no taxes. The bottom 20% actually get money from the government every year. So exactly how much tax do the wealthy have to pay before it's fair? Because they're already paying a big bulk of it. But the problem is that the original income tax was a 3% tax on wealthy people, and nobody else was supposed to pay tax. But as is always the case, every time we go to tax these wealthy people, it filters down, and the bottom 80% wind up having to pay a lot of taxes. And so now we have this massive tax code that we can't do anything with because it's so integrated and ingrained into the system, you can't change it. And we tried it, right? We've had people promote flat taxes and fair taxes and everything else, but you're not going to get rid of the IRS. That's the whole problem. It's an ingrained system into the country, right? That's very difficult to change without a revolution, which is how we started this whole thing back in the day. But we have to deal with taxes, right? But we can choose how we deal with taxes. But our job is also to make money, right? Make our money grow. And I cannot tell you how many people I've seen, over 40 years of managing money with people, for people, investing for people, whatever it is. And I've been through multiple things. I can't tell you how many people I've seen turn absolute massive gains into losses because they were trying to avoid paying taxes. And it works great. Great example was in 2008, actually 2007. I had a client come in. Her mother had died, left her a huge stake in Fifth Third Bank. Her mom had been an executive at Fifth Third Bank on a lot of stock, and about 90% of this person's portfolio was Fifth Third Bank. She didn't want to sell it because she didn't want to pay taxes. So first of all, there was an estate step up, which lowered her tax base on her capital gains, and she had some taxes because there was a big run in bank stocks going into 2008. But she didn't want to pay what would have equated to about $100,000 in tax on a several $1,000,000 account. But she didn't want to pay the $100,000 because she was just opposed to paying the government any money. Well, by the end of the 2008 financial crisis, that total portfolio value was worth about $100,000 because of the collapse in Fifth Third Bank stock price. She didn't have to worry about paying taxes at that point, right? But what was the purpose, right? What did you actually save? And so, I got an email yesterday, I'm talking to this person and it was like, well, I would really like y'all to manage my money, but I've got this big gain and I don't want y'all to sell this stock because I don't want to pay the tax on it. I'm like, well, we can work around that, right? We can do some hedging and we can do some other stuff. But I said, but really, what are you trying to do, right? It's like, I just don't want to pay any taxes. I'm like, but why, right? You made money. That was the whole goal. The whole goal was to invest for growth. You've done a fantastic job, but you've got a concentrated position in your portfolio, and now you're worrying about paying capital gains. That was the agreement you entered into when you started buying stocks, is that eventually you would pay taxes. That was your agreement with yourself. Because that's the only way you make money. You don't make money in the stock market until you sell something. It's all virtual fun and games until you actually sell something. So you have to come to the agreement that you're going to pay taxes. And Danny, you had basically the same question yesterday.
Well, we get that question quite often. And, I think we have to take a step back sometimes and understand what it's either the fruit of your labor or the fruit of a really good investment. Now,
Or fruit of the loom.
Yeah, well, okay.
Yeah. And yes, there was a cornucopia back in the 70s.
Are you going to go down that rabbit hole now?
I'm just telling you there was. Because I have a pair of underwear from the 70s. So.
Oh, man.
Anyway, go ahead.
And that's why he's in the 0% tax bracket. So, what Lance is specifically discussing here is, somebody who's had, and multiple people obviously who've had large concentrated positions. And those are things that, give me a little bit of heartburn in the sense of, great, you've done a fantastic job. You may have worked there. You may have a loved one. You may have inherited funds. And a lot of times, even with inheritance, we see it's not just the taxes, it's the emotional attachment to that position because, my father bought that. My grandparents bought that. They never sold it. They held it. But we have to understand market dynamics shift and change, but also the risk changes over time as well. And so keeping these things in mind and understanding, okay, what are the goals and objectives for these funds? I get it. Nobody wants to write a check to Uncle Sam. I think that most people are much better steward of capital. We could probably all agree. And so that's one of the most difficult checks to write. However, we have to understand that what is the risk associated with those positions, especially if that is a large portion or the bulk of your net worth. And, we do get a lot of clients that come in, they have large capital gains, that we bring those in. We try to very effectively and strategically take taxes that may be over a number of years. But when you have somebody with just one or two large positions, that is where we see much bigger issues. And as Lance, you mentioned, you talked about Fifth Third. We could name a lot of companies that the same exact scenario has occurred.
Yep.
And some of them were just completely, all value was diminished. So that's where I think, we need to start saying, okay, let's come up with some type of plan. How do you structure out liquidation? Is it over time? Is it a little bit? I mean, we can go and we can go buy a put for insurance, right?
Yeah.
Anybody can go do that.
Right cover calls. Generate some income while you're waiting to sell off portions of your asset.
But you need to understand what's the strategy to liquidate if you're starting to utilize these options, and understand that, okay, well, if the stock price goes down, you're going to make a little bit on the other side, but then you're going to have what? Capital gains, taxes, right? So effectively, this is the question we get a lot, and not just with individual stocks or, a portfolio that's done well. The diversified portfolios are a little bit easier to manage on that because we can pick and choose. We can liquidate little bits over time. And, we don't have this big concentrated risk that, we have a more systemic risk in the sense that the whole market falls, but you're typically going to be a little bit better off than holding that one larger position. But I think that, we handle a lot of liquidity events for clients, businesses that have been sold or, selling real estate. Maybe it's not your primary home. How do you avoid those taxes on it? Seems to be the big question. A lot of it is too, even the primary residence, right? We can exclude up to $500,000 for a married couple or $250,000 if you're just an individual taxpayer from capital gains taxes when we sell our primary residence, assuming we've lived in it for the last 5 years. And, some people bought homes back in the 70s or 80s and they've seen substantial growth in their, hey, I sold for $750,000 profit. What can I do for that extra $250,000 to avoid taxes? There are some very sophisticated ways that some things you can do. We'll get into that in a little bit on something like that. But for the most part, there's no magic wand. We don't have that magic bean that says, hey, here's how you get out of it. And, the key here is that understanding bigger picture. What are these funds intended for? What are you using them for? And if you've held them forever, it's a different story in the sense of, okay, do you need these funds to meet your cash flow needs? How have you been utilizing them, or how will you utilize them in the future? And I think that's where we got to take a step back and say, what is my understanding of these funds and how they're going to work? Because if not, this could all be for nothing if things were to fall apart and deteriorate. And a lot of these things, especially if we're just an investor, they're beyond our control. And, when you talked to this guy the other day, what was his comment back?
Well, he finally came to understand that, he was worrying about the wrong thing. And then once you start talking about how to structure it out, look, you do a little this year, you do some tax loss harvesting along the way, to offset your gains. I mean, there's a lot of ways to mitigate that tax, right? And it's just a lot of things he didn't really understand. He was so wrapped up in this big capital gain and having to pay taxes on it that he was missing the whole point of what he was trying to achieve. And that was my point earlier, is that we get lost focusing on this one thing, trying not to pay for something. We don't want to pay taxes. Okay, great. But you're missing the whole point of why you were investing to start with, which was to grow and preserve capital. And when we come back from break, we can talk about 1031 exchanges. We can talk about, I have a client that has a very interesting way to avoid taxes. They do a lot of real estate. They figured out a way to do a 1031 exchange into MLPs. So there's all kinds of things out there to avoid some taxes. You just have to know where to look and have a really good accountant.
And attorney.
Really advise you a good accountant and attorney. Absolutely. Be right back.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Building anything of substance requires careful planning, including your retirement. You need a blueprint to structure your funds against volatility and turbulence in the market. If you fail to plan, you plan to fail. Richard Rosso and Danny Ratliff share the RIA Retirement Blueprint. Saturday, September 14th at the Hyatt Centric in the Woodlands. How to structure your savings, level your risk, and craft a secure future. Register now for the Retirement Blueprint with Ratliff and Rosso at realinvestmentadvice.com. Realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
You have to love Texans, and you have to love Texans back in the 70s because we didn't really know better. You take a big propane tank and you stick it in the back of your truck and make the connection to your car so that you have propane-fueled engines because propane was cheaper than gas.
The Real Investment Show podcast.
Gas was almost $1 a gallon. It was outrageous.
Same show, your schedule.
You were a mobile bomb, but
at realinvestmentadvice.com.
But you didn't have to pay for gas.
Oh, man.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning. At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. Realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
Building anything of substance requires careful planning, including your retirement. If you fail to plan, you plan to fail. Richard Rosso and Danny Ratliff share the RIA Retirement Blueprint. Saturday, September 14th at the Hyatt Centric in the Woodlands. Register now for the Retirement Blueprint with Ratliff and Rosso at realinvestmentadvice.com.
You're listening to The Real Investment Show.
Welcome back to the show this morning. As we were wrapping up there in the last segment, I was talking about 1031 exchanges. I misspoke. I said MLPs. I meant royalty trust, like San Juan Basin Trust. We have a client that uses royalty trust as a 1031 exchange. I don't advise you doing that personally without having a really good tax accountant and a good tax lawyer on your side because there's some loopholes you got to jump through. But the point is there are kind of the tried and true way to avoid taxes. Like, for instance, as Danny was talking about before the break, you know, you have a piece of investment property and you sell it, and you bought $1 million property. Now it's worth $2 million, so you go sell it. So you're gonna pay capital gains on $1 million. Well, one way to avoid those taxes is you can roll that money into another investment property, 1031 exchange. That's normally how it's done. And there's lots of creative ways to take advantage of the tax system. And this is, but this is why this goes back to a conversation that John Penn and I had probably a month ago, which is the value of having a financial advisor. Because this is where you go to your financial advisor and say, okay, here's what's happening. This is what I'm about to do. What do you think? And then they can help you walk through that process, saying, hey, before you do that, let's go talk to our accountant. Let's go talk to your estate attorney. Let's go talk to your tax attorney, whoever. Oh, you don't have one. Let's go find one. Talk to them about, your situation specifically and what we can do to minimize those tax inputs. Because there's a lot of, this is why rich, this is the big complaint about, this is why we have to tax the rich, right? Rich people don't pay their fair share. Yes, they do, right? But they also have very, very good tax people, tax attorneys, tax accountants, et cetera, that help them take advantage of so many different things that exist in the tax system to lower their taxable liability. Charitable giving, foundations, all these type of things help reduce their tax liability that they would pay. One of the big fallacies about taxing the rich is people like Elon Musk and Jeff Bezos or any of these CEOs of companies that are head of major companies like Amazon or Google or whatever. They're the ones that are always the target for the tax the rich scheme. Well, Jeff Bezos only paid 2% of his income tax last year and his income, right? Or whatever it is. In a lot of cases, this is their lifestyle, their private jets, their yachts. Mark Zuckerberg recently bought a $300 million yacht, right? And has 4 diesel engines, and it's one of the giant polluters of the environment. But it's $300 million. Well, he didn't pay cash for that, right? He has a banking relationship, and he owns a lot of Meta stock. Same thing with Jeff Bezos. Same thing with Elon Musk. And they go to the bank, and the banker says, oh, you want to go buy a $300 million yacht? No problem. You pledge $300 million worth of your corporate stock, and we'll give you the $300 million, and you can go buy your yacht. There's no tax on that transaction. It's a loan. It's just a loan backed by their shares. So there's no tax. So a lot of their liquidity comes from financing off of their shares of ownership that they're not selling. And that's why their tax rate seems to be like, oh, look at their lavish lifestyles, their private jets, their cars, there's multiple houses. A lot of that is on debt. It's all backed by corporate stock. They could pay it off tomorrow if they sold their stock, but they don't have any tax. But that's just one of the ways that they manage their tax liability, by having a very good accountant, they have, groups of advisors, accountants, lawyers, financial advisors, et cetera, all working to manage that worth. And you can have the same thing, right? You just need to go out, and this is where you hire a good financial advisor that has great relationships with tax accountants, tax attorneys, estate planners, et cetera, to manage the very thing that you're trying to avoid, which is paying taxes. And yeah, are you going to pay a fee for that? Yeah. It's less than the 20% or 30% tax you're going to pay to the government.
But and you got to think back. So those specific instances that Lance just brought up, we hear about them often, and they always make headline news whenever they do something. And oh, can you believe they don't pay a lot in taxes? Right. Well, most of them don't make a whole lot
in salary.
Right?
That was because of Bill Clinton.
Yeah, because at that point, they looked at the ratio of what CEOs, executives were making compared to the average employee, and said, okay, they can only make X amount in salary in relationship to their employees, right? It's a bad look. Well, they use this to their advantage.
That's right.
It's a great, pay me in stock. And so if you're somebody with intimate knowledge, so this is where, having a little bit of a concentrated risk, they have intimate knowledge of, they also historically are already fairly wealthy. So if things fall apart, these guys are going to start over. They're risk takers. They're opportunistic. They're optimistic. And they're optimistic on, also their companies that they're running. They've got great track records. And so for them to walk into a bank and say, hey, tell you what, I want to put margin on this, or I want to use this, collateralize these funds. They may say, hey, yeah, put up $400 million. We don't know, your stock's pretty volatile. We'll give you that $300 million. Mm-hmm. And if it doesn't work, we'll sell it. We'll go down the road. But they've got now an expense that they may be able to potentially write off, depending on how it's structured, how they're holding it, in that interest payment that they make. And hopefully they're thinking that stock's going to continue to do well, and it's going to outpace that. So they say, I'm good with it. And that's how they avoid taxes. Now, listen, not everybody's going to have access to that type of thing, nor maybe do you even need it. Because what we do see a lot of times is where people begin to speculate, mm-hmm. right? And then they get way over their skis, and that presents other problems. But in general, there are ways to do these things, and we have to be cautious. But you need to know what's out there. So, for example, you could be selling your home, right? Let's say it's a vacation home. Came across an article yesterday about this, and it was pretty good. And you're going to go liquidate your vacation home, and it has $1 million of capital gains. You've held it for the last 20, 30 years. So maybe you don't want to go buy another one. So you don't want to do that 1031 exchange. So basically, that's where you're going to go buy a like-for-like property. You're going to sell this vacation or rental home. You're going to go buy another one somewhere else. You say, I want to get out of the real estate market. I think prices are really high. I'm going to wait a couple years before I buy something again. Or maybe I'm not going to do it at all, right? We just don't use it. So you can utilize that 1031 exchange by, and basically defer those taxes. You're not eliminating those taxes. You're only deferring them. Now, the other thing you could do is a structured installment sale. And this can be good and bad, right? You may negotiate with the company. Now, I see this with buyouts. I see this with a number of different things where even with severance, we say, listen, I don't want you to pay me all in 1 year. I'd love for you to pay me over the next several years. So you could basically negotiate that with the company. Now, you're still taking risk that the company will be there because they're historically going to put it in a specific plan that, creditors could likely get to. So the other way you could do it would be like a structured installment sale annuity, where you have the buyer deposit the funds in an annuity for you, and then you get to defer those taxes. You're still going to have to pay them, but instead of receiving them all at once, you can pay them over many years or several years, depending on how you want to set it up. So there are ways that you can eliminate, maybe a little bit of that taxation, but not for everybody. I mean, in the instance that Lance brought up that kind of sparked this conversation, listen, you're going to have to pay taxes if you're going to liquidate these bigger positions. And, deal with a lot of people have done very well, a lot of success. And, my goal is I want to mitigate taxes for clients. I want to keep more money in your pocket. And so we're looking for every avenue. We're uncovering every leaf, trying to determine, is there something you can do? Now, all legal within the law, right? And that's why we want to work with really good CPAs and attorneys. But taxes, a lot of these guys say, listen, if I'm not paying money in taxes, something's wrong. Mm-hmm. I wouldn't care if I paid $1 million a year. That means I'm making money. I'm doing something right. So sometimes we may just need to change our mindset a little bit, because I'd rather you keep money in your pocket than just hold on to something that's, it's a sinking ship, and then we get out at the very bottom. The example you gave, what was that portfolio worth at the beginning before it went down to like 100,000?
$5.5 million.
Wow. Ouch. So you got to just think about this in a little bit different ways. I mean, we're here to help any way that we can. We love to provide this type of information, but there's a lot of different avenues that you can explore and things you can do. And some of it's just simple. I know we've talked about a handful of sophisticated strategies. You may say, well, this doesn't pertain to me. But also, if you're over required minimum distribution age, which is 73, where you must take withdrawals from your IRA, you can do qualified charitable distributions. So meaning, if you're tithing to the church or you're giving money to charity, you can gift directly out of that IRA or 401k to that institution. So you're not paying taxes, then gifting, then getting the tax break. You're going to write the check directly to them, and we can do up to $100,000 each year. So there's a lot of small little low-hanging fruit you can take advantage of, and we see a lot of times that they're just not taken advantage of properly. And then, we can get into distribution of funds, having a plan, a strategy to reduce those expenses to Uncle Sam. But yeah, lots of different things you can do to accomplish those goals. But sometimes you just got to bite the bullet.
Well, and look, the whole point of this conversation to start with is don't worry about paying taxes. That's just part of the game. Our goal is to grow money and grow it smartly. And there's lots of things we can do to mitigate our taxes, right? And so don't overlook that. Don't get so wrapped up in just paying taxes that you make bad financial mistakes. Be right back after the break.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Building anything of substance requires careful planning, including your retirement. You need a blueprint to structure your funds against volatility and turbulence in the market. If you fail to plan, you plan to fail. Richard Rosso and Danny Ratliff share the RIA Retirement Blueprint. Saturday, September 14th at the Hyatt Centric in the Woodlands. How to structure your savings, level your risk, and craft a secure future. Register now for the Retirement Blueprint with Ratliff and Rosso at realinvestmentadvice.com. Realinvestmentadvice.com.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
The Real Investment Show.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. Realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So, as you're hanging out in our chat this morning, we appreciate you being here as always. Be sure and go by the website, realinvestmentadvice.com. Michael Leibowitz's new article out on the website now. I had an article out on Tuesday as well. So, lots of new stuff for you to read about markets, economy, etc. all at the website. It's all absolutely free. Of course, make sure you're subscribed to our weekly Bull Bear Report. That's where we put all of our stock analysis, stock screens, market analysis, etc., all in that report on the weekend to help you have some stuff to work with and, finding stocks to buy, etc. So if you subscribe, we email that directly to you. It's free of charge, of course. And so that's there. So we appreciate you. But there was a study out this morning, and you have about an hour and give it about 14 minutes until you know if your day's ruined. So how much misfortune does it take to throw someone's day off course? For many Americans, one rough morning can derail everything. This is according to a study that was currently conducted by the Talker Research for Avocado Green Mattress. What is it with mattresses and colors? I don't get it.
You got the purple.
There's the purple. There's the blue. There's the avocado green. I'm waiting for a yellow one.
I think it's just branding, right? I mean, everybody's trying to distinguish themselves and separate from others. And, mattress is a mattress. I mean, to some extent, right?
Mattresses are expensive. We just had to buy a new mattress.
I've got to buy a new one, and I can't bring myself to do it.
Yeah, they're kind of.
So, we had our house situation. So our daughter took one of the queen mattresses. She had a full, and I was putting and I didn't realize it at the time. That's what she was sleeping on. It just, house is in disarray. And I went to go set up the guest bedroom and put the mattress on. I'm like, oh, this mattress is not going to work.
Yeah.
Hey, babe, we're going to need that mattress back. She's like, no way.
Funny.
I was like, oh, great. But yeah, they're not cheap.
They're not cheap.
So I guess my guests will find out how much I love them.
Yeah, exactly. Kids are great. Just wrap some cardboard boxes up in a sheet. They'll never know the difference.
Well, that's what Michelle said. She said, while she's at school, we'll just go switch it out. She'll never know. I was like, I think she'll know. Like, she has been... Yeah, she's like, I sleep so much better on this one.
I bet she does.
Right.
So a survey conducted by Talker Research for Avocado Green Mattress reveals that the average American can tell by 8:36 a.m. if they're headed for a bad day. The poll of 2,000 people found that the average person experiences 4 bad days a month, adding up to a staggering 48 days or a month and a half of bad days each year. You know the way you know how I know when a bad day is coming? When I have a really good stretch for like 2 weeks or 3 weeks, like everything's just going great. I just start getting this nagging feeling that something's about to go haywire. And we'd gone through about a 4-month stretch earlier this year of just everything was perfect. Everything's working great. And then the month of August, I am so glad this month is going to be over. It has just been one disaster after another this whole month. So I just my bad days, they don't get staggered out over the year. They all happen in a month. It just
I don't know, Lance. I may take that, right? Because I know what your bad day has been. And it's probably not that bad. I've had a year.
You don't know that. Yeah, we've had a real issue with our daughter for the last month. So. But fortunately, all the tests turned out fine. She's healthy, turned out great. But it was a pretty big scare.
No, that is scary.
But anyway, so
dang it. See, you had to do that and make me feel bad now.
You're going to complain about your little house situation over there. Anyway. I'm just picking on you this morning.
All good.
But anyway, so one of the most surprising findings is that 26% of respondents, a single morning mishap can make the entire day feel like a loss. So here's the top 5 morning mishaps. So if you're in our chat and have one of these mishaps, just, put a 1 in the chat and we'll take a look at a quick poll. Waking up feeling sick, sleeping poorly during the night, waking up with a headache, misplacing your keys, and forgetting your phone at home. Those are the top 5 that set you up for a bad day. Now, I don't really understand. I've left my phone at home before, and I'm like, oh, well, it'll be there when I get home.
I'm free.
Yeah, it's kind of a relief, actually. So I don't get that. I mean, misplacing keys, I don't ever have that problem because I have a bad kind of OCD habit. I have to have everything in its place.
Yeah.
So I've got a specific place for keys, and if they're not there, it's not me. Somebody's moved them.
That's my biggest problem because the other day I was doing some work in the backyard and I keep hearing the car, the beep for locking on the vehicles. Beep, 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 beep. I'm like, oh my gosh, what's going on here? First I thought somebody was outside jacking around. No, my little one's upstairs with the key fobs. Thinks it's hilarious. But that's what happens, right? They think it's funny, and then I get up at 4 and try to look for my keys, and it's like, oh my gosh. Just move little stuff. So yeah, I'm the same way where you've got to be But so I don't wake up with headaches. Hardly ever.
Jeffrey in our chat, he had all 5 of them.
All 5 of them? Oh man. Yeah, that's a bad day. Now, if you had all 5, what was the cause of that? Were you doing something previously?
Exactly. That's the real question. But anyway, so like I said, in about an hour and 30 minutes, you'll know if you're having a bad day or not. I guess that's if you wake up at a normal time. So like for me and Brent, we get up way before dawn, right?
So we'll know by 5:36.
Yeah, we know. We pretty much know Brent knows if there's going to be a bad day or not. Is that when he walks into the studio, if there's no AC, the power has gone out overnight, there's no internet connection, or the computers won't start, it's going to be a bad day.
And some days it's all of those.
And some days it's all of those at once.
But those are things out of your control.
Yeah, but it's frustrating. It does. Yeah. It's frustrating. It sets you up. Okay, real quick. We got about 5 minutes, Danny, so just to kind of wrap up. 8% of workers say they're going to wait till 70. Let me reread that. Only 8% of workers say they'll wait until 70 for Social Security. This was according to a survey. In a Schroeder survey, 43% of respondents said they plan to claim benefits before the age of 67. Non-retiree respondents, on average, forecast they would need about $4,947 a month to live comfortably. 38% of employer plan participants said their plan provides their sole income for retirement.
Yeah, which is really scary when you start thinking about that. So the stats are that, Social Security, people that are receiving those benefits that you put into, you're about 62% of people rely on that Social Security benefit for about 50% of their income in retirement. And there's actually a quarter rely on it for 90% or more. And, we've talked about this because it's important to understand, we keep looking at the numbers. The Congressional Budget Office will come back out. They're going to give us an idea on when they're going to be deficient on funds and not be able to fully fund it. Like we've always said, something will be done because of the sheer amount of people that are on it and that need it. But when we take it early, we take a pretty significant discount. And so if we're taking it before full retirement age, which for most people now is 67, if you're born between 55 and 59, it goes up by 2 months from 66 all the way to 66 and 2 months, 66 and 4 months. But majority of people now moving forward are going to be 67 and above as far as when you're full retirement age. So if you take it prior to that, which we see a lot of people retiring at like 62, 63, and many times it's more of a forced retirement. They need to take care of a loved one. They're sick, something's going on, or maybe you're just out of work and can't find a new job at that age. So, when we're taking that, and if you do take it early, sometimes it's just going to be necessity. You're going to have to take it. But many times, we do see people that are still working and they see the headline. They're like, oh my gosh. The other headline is Social Security misappropriated $72 billion.
Wink, wink, nudge, nudge.
So you're like, wait a second. Well, I got to get my money out now. Well, guess what? If you're still working and you take it before full retirement age, you could have benefits withheld if you make too much money. You have an earnings test. And so most people that I find that take that ahead of time, they didn't know about that until they get a letter from Uncle Sam saying, you owe us $33,000 or whatever that amount is.
Right.
And that's scary. But you're also going to lock in that discount, especially, so you've got to start thinking about longevity. We need to think about our spouses. If you're the breadwinner, the high income earner, and you pass, your spouse will get that step up to whatever your benefit was. So obviously we want that higher for them if we can control that. So it is, we talk about that often, how it's a decision between both couples, not just one. But, I think the thing that scares you is that only 8% are going to wait. And so you also need to note that between full retirement age and 70, every year you're going to get an 8% increase in benefits. That's guaranteed. And, we find that a lot of plans, we're going to talk more about, planning and withdrawal rates and things like that, especially as we begin to see rates decline. You're going to hear more and more news about the 4% rule. But what we've noticed is with guaranteed income, you basically have guaranteed lifetime income with Social Security. Your plan works better because it's not a variable asset. It's not something that's going up and down. You may have Social Security and a variable asset or have a very concentrated position, and it may be real estate. It may be a stock. It may be, another type of investment. But by taking it early, we lock in that number at a much smaller amount, which can have a negative impact on plans long term. I think most people ideally want to wait, Lance. I think it's difficult because we hear, it's kind of the fear mongering. We hear all this stuff. And listen, at some point, maybe they cut benefits, but can you imagine if they did? We've got a problem now. Most people aren't above that poverty line. We've seen wages come down substantially. There's issues out there. So I think, this is something that you need to make sure you're maximizing it. Get with a good advisor, run the numbers, see if you're leaving money on the table because a lot of times it is quite a bit. And go sign up, realinvestmentadvice.com. Richard and I are doing a retirement blueprint seminar workshop. Love to have you there. There's no cost to you. Get to meet some people in person, covering all these topics and more.
There you go. All right. Have a great day. We'll see you back here tomorrow. Be sure to like and subscribe to the channel as well. We appreciate you. And we'll see you back here tomorrow with Michael Leibowitz.